Well, hello and welcome. In this video, I'm going to share with you some of the important lessons that we learned helping our clients navigate their retirement during a pandemic. Now, I'll tell you a little bit more about myself in a minute, but first I want to ask you a couple questions. Before you came into 2020, how did you feel about your retirement? How confident were you that it was on track? Now, I remember 2020 feels like it was a lifetime ago, and that somehow we've been moving in slow time vacuum since that point. So then I want to ask you the follow-up question to that is, how confident do you feel now? The world is always changing, but it feels like it's changing a little bit more than it has ever before. We ended 2019 at all-time market highs with low unemployment and what felt like a healthy economy. People were talking about potentially retiring early or going on an extra vacation or doing things that they hadn't really thought about doing. Then the world stopped. And social distancing, working from home, masks, and mass unemployment hit the headlines. And the markets responded violently. The velocity of that recession was 14 times faster than average. What I mean by that is typically to go from a market high to a market low through a recession like that takes about 340 days. And yet we accomplished it by ripping the Band-Aid off and hitting the bottom in 23 days. That was an extremely violent market move. And now the markets are back to all-time highs again. And many of us have some whiplash. And people are uncertain, they're unclear about their financial future. Now, when the initial outbreak hit, we had the opportunity to reach out to our clients and start talking to them over Zoom. And we asked a couple of questions. How are you doing? And how is this affecting your family? And there were some common themes that we heard back. It was a disruption, that they were nervous about the future. And they didn't know what it meant for them, and they didn't know what it meant for their family. But then something turned, and we started being proactive. And they started asking questions about, can we model some scenarios? I don't mind working from home, so maybe I can work a little bit longer. Or maybe it looks like I'm going to lose my position, I might need to retire early. Or maybe social distancing is a little bit fun, and I want to actually consider moving to a new area. There was a whole host, and it was different for everybody, but there was something that they were starting to think about and actions that they were wondering could or should they take. And so we had those conversations, and overwhelmingly there was this sigh of relief, and I would watch people's shoulders drop over a Zoom call as they realized that not only were they still on track, but there were actually meaningful actions that they could take to do something about their situation. I want that sense of confidence for you. That, by definition, is called planning. That's what we're about at Pine Grove. And there are some important things over the next 15 minutes that I want to share with you. First, 3 key takeaways, and there were many takeaways from this experience, but 3 key takeaways that our clients told us were the most impactful for them as we went through this. Then, I want to share with you a proven process that we've developed to help you manage the things that you can control. And then lastly, I want to talk to you about our mission at Pine Grove, who we are and how we can help. Now, the financial reset has caused many people to refocus on their retirement. And maybe you're nearing retirement wondering, am I ready? Maybe you're recently retired and now you're wondering, is this sustainable? The kids may have graduated and now it's time to look inward and figure out what does the next chapter of life look like for us as a couple. Maybe you're just realizing that it's time to get organized and time to have a plan. Well, if that's you, you've come to the right place. My name is Jeff Clark. I'm a wealth advisor with Pine Grove Financial Group. I'm an enrolled agent with the IRS and a certified financial planner, and I do fiduciary financial planning for my clients. I have a specialization in the areas of retirement taxation and income planning. And you've probably heard of us, Pine Grove. We've been in the news on KARE 11 and CBS, WCCO, and Fox, and we've been in various articles like Forbes talking about being one of the fastest growing firms in Minnesota. So our name is out there, and it's good to meet you. But let's stop talking about me for a second. I want to focus on you. What are the takeaways that we learned as a firm that we can share with you? And more importantly, what are the takeaways that the clients told us were the most valuable to them? There were many, but 3 stood out as being really powerful. The first is that investing in retirement required a different skill set that they themselves felt unprepared for, especially when relying on that income during volatile times. The second takeaway was that Without a plan, good savers can actually be penalized by higher taxes, and knowing what actions to take now could actually move the needle in their favor. And then the third takeaway was that just having a plan before the pandemic gave them the playbook that they needed to be able to start taking meaningful actions during the pandemic. Now let's dive into each of these and kind of break them apart and peel back the onion a little bit. The first is, and I know I'm preaching to the choir here, when you need the money, it's different, right? When you're saving for retirement, it's this far off thing that it's not that, I mean, it hurts when the market moves, but it doesn't hurt the same as when you actually need the money. Now in March 2020, reality started setting in, and people started asking themselves some questions. Did I invest wrong? Should I sell? What should I sell? Maybe I should be buying. I should buy into the dip. Or maybe I just need to hold cash and wait because I don't know what's coming up right now. And of course, wait for what? How do I know when it's time to get off the sidelines and take action again? And is it really different this time? Because all of the financial networks are telling me that these are unprecedented times. And they can run with that headline anytime they want because the future is always unprecedented. It's never happened before, obviously, right? So what is the common thread amongst all of these questions? Well, the common thread here is human nature is for us to look at our 401k statement and it's a certain threshold, it hits a number. And then if it rises above that number, well, we feel like we're winning. But if it falls away from that number, now we feel like our future is at risk and that we're losing somehow. And I want to ask you an important question. So listen carefully. Is your account statement really a fair scorecard that you're doing okay? I would submit to you that it is not a fair scorecard and that there are at least 6 factors that affect your retirement health, and only one of them has anything to do with the stock market. And it's easy to get lost in, lose the forest for the trees, if you will, looking at one area that you have very little control over and not recognizing all the areas that you do actually have the ability to make an impact on. So as we go through this process, I want to share with you what those 6 factors are because they tie into that third element of having a plan. But let's talk about investing for a minute. How would you describe your investment strategy? Would you call it a proven, consistent, repeatable process where you're consistently following the same format to select the right investments with a rules-based approach to rebalancing those investments, one that's actively managing your risk as the market changes, that's tax conscious, and will design and create a sustainable withdrawal plan to make income last as long as you do? Well, in thousands of conversations with people over the last 10 years, I have never found a couple who sat down, read through this list and said, yep, I can confidently say that that describes my investment strategy. They all want that, and I want that for you. And so I'm going to show you some of the basic elements around how we do this for our clients. First, it just starts with having the right allocation. How do you manage a portfolio during volatile times? Well, it starts by entering those volatile times with the right mix. And this is an oversimplified example, but let's assume it's half stock and half bonds. Well, that's a starting point, but then what do we do with those investments when the market starts to move? Because it doesn't hold still. Now, when the market started to sell off, we heard that over and over again. The market is falling, the market is crashing. Well, there are many markets. And if you look at this graph here, 2 of them actually made money during the pandemic and are still up right now from January of this year. The blue line and the red line are bond markets, which rose in value. The pink and the light green and light blue lines there are stock markets that sold off as the pandemic hit. Now, an overly simplistic approach, easy to describe, hard to actually implement, would be to sell bonds as they started rising in value and start buying stock while it was at a discounted price. Because by doing that, you put your ratios back to the initial 50-50 mark and give your portfolio the opportunity to actually rise back faster because it bought a bunch of stock at a discount. So you could actually benefit from the market sell-off. And what I really find that people struggle with is that they don't have a methodology to answer the following questions. When would I sell? When would I buy? And what would I buy and sell, right? That process and being able to answer those questions is key to being able to actively rebalance your portfolio as the market's moving. That's something that we set on autopilot for our clients, that automatically, out of sight, out of mind, as the market is moving and adjusting, we're proactively doing that on their behalf. But then you can go one step further with it, which is if you're coming into a really windy road, it might make sense to put the brakes on a little bit. And then once we hit the straightaway again, we can go ahead and hit the accelerator and let off the brake. Well, you can do the same thing with investing by just managing your reserves. So you can hold more in cash or more invested, basically taking chips off the table and putting them back on, and definitely not selling everything. That would be crazy. But you can be strategic with it by looking, we use something called a market risk indicator, where we look 30 days into the future and just make an estimation of how volatile we expect the market to be. And in highly volatile times, we hold a little bit more of a cash reserve. And when the market is more stable, we hold a little bit less. Clients told us that having all of these elements in place for them before the pandemic hit was one of the most valuable things that they had. Because what happened was they saw the news and they saw the market crashing around them. They saw the death toll rising online. And yet, then after our conversation, they realized that their portfolio had hardly moved at all. They were down a little bit, but not significantly. And their probability of success of their retirement plan had hardly moved at all. That was really empowering for a lot of our clients. Now, that's just the investing side of it. The next area that people said was tremendously valuable was understanding taxes and what they could do about it. And many people are surprised by their retirement taxation because, well, for those that have saved enough to be well and on track to retire well, most of them have done almost all of that saving in pre-tax accounts like a 401k, which means most of that savings has never been taxed. Now think about it. If you have $1 million inside a 401k, how much of that account is actually usable money to you? Well, it's not $1 million because you have to pay taxes in order to use it. So being able to manage how that money leaves that account so that you can get the most of it for your own personal use is incredibly powerful. Now, I want to do an example of this with Bill and Sally. This is a sample couple, so they don't really exist, or imaginary couple, but I want you to pretend that you are Bill and Sally sample here. They're age 60, retiring in 5 years. They make $150,000 a year, and they're saving 15% into their 401k. They'll take the standard deduction, and so far, they've saved about $750,000 in their 401k, which means they're on track in 5 years to be over $1 million. Now, if I were to ask them, how much of your income is taxable, and what's your tax rate? What do you think they would tell me? Let's imagine we're sitting down having a cup of coffee, and I just asked Bill and Sally, how much of your income is taxable? They'd look at me and say, every red cent, all of it, right? And if I asked them, what's your tax rate? Well, they'd say, well, probably the 22 or the 25% bracket. Well, technically that's true, but it really is a little bit misleading. Because if you look at their tax return, on line 1, even though they make $150,000, only $127,500 even gets reported. That's because 15% was pulled off the top by their employer-sponsored plan. So they did get paid that money, but it's not reportable as taxable income. And then after we get down to the standard deduction, forgetting itemized deductions back from 2018 and before, they're down to $103,605, which means they make $150,000 a year, but only $103,605 is even taxable in the first place. Now, imagine Bill and Sally's shock if I were to tell them, you know what? I would estimate that about 1/3 of your income has never been taxed in the last 10 years. Without looking at their tax return, they'd be shocked to learn that. And yet, if I told them, you know what? I would bet that your tax rate is not 22 or 25%, but your federal rate is probably somewhere less than 10. In this example, their federal effective rate is 9.6%. Again, they would be shocked. Now, why am I sharing this with you? Because there's this perpetuated idea, this ongoing myth, that we've been told that at the end of our careers, we're at the highest earnings capacity we'll ever have. Therefore, we need to get as much of a tax reduction as we can get right now, because eventually when we get into retirement, our taxes are going to go down. But these are the years where it's critical to get every deduction that we can get and lower our taxes. Well, I'm here to tell you that that's not true. And we need to stop being so short-sighted, because taxes are not just this point on April 15th every year where we look at something that's really annoying and it takes a lot of time and then we forget about it for the next 12 months. But our taxes are actually a progression over time. If we were to take Bill and Sally's tax return and stretch it out over the next 20 years and look at where they're heading and how they'll move through the tax brackets, we'd get a very different picture of taxes. Now, this chart is assuming the tax code remains unchanged from what it is today. That they start out with a fairly high income while they're still working, and then it eventually does drop off a little bit as they move closer to 70, but then required minimum distributions hit and start forcing money out of those pre-tax accounts in their 70s, and they're in higher taxes for the rest of their retirement. They start off at around a 9.5% effective rate, and by the time they're done, they're over 15%. That's a 57% increase in their taxes over time. But they're not stuck. The Tax Cuts and Jobs Act that was passed a year or two ago will expire in 2025, and there's an opportunity right now where they can make some meaningful changes. One strategy is through Roth conversion, where they can start moving some money from their pre-tax accounts to Roth each year, maxing out that tax bracket, which is that yellow line there, prepaying taxes at lower rates now to avoid the higher rate avalanche that's going to fall on them in the future. By doing that, they could save a little over $400,000 in taxes. But there's more, because they probably are not going to live to the same life expectancy. I realize, as I said, but there's more, it felt like a commercial, right? Well, it's not, but it's genuine. There is more, because if they don't live to the same life expectancy, one of them is going to be a single filer. Well, the tax rates for single filers are much more aggressive than they are for married couples. And assuming that Sally outlives him, now she has the rest of her life where she's paying taxes above that yellow line. As you see, it's moving up much farther. And in the future, the tax rates could be more aggressive. They're already set to go up in 2025, but what if tax rates rise in the future? Well, if we just kept the same tax code that we have today, just by doing this strategy alone, a little bit of proactive tax movement each year could save them $405,000 to $431,000. $431,000 over the course of their retirement. Remember, they entered retirement with about $1 million, and here we're looking at saving them between $400,000 and $430,000. That's incredibly powerful. This is an area of financial planning that is tremendously missed. And the reality is, when it comes to taxes, we think of it as what happened this last year so I can get it reported correctly in order to file appropriately this year. But it's very rare that anyone has done any projections on where you're headed based on the balance of your account, how you spend your money, how you're going to claim Social Security, if you have a pension, what state you're going to live in. All these things play into what your tax rate looks like over time. If you don't get a handle on that before you get deep into retirement, there will be nothing that you can do about it. So in navigating retirement during a pandemic, there's those three key takeaways were just having a volatile market investment plan before the market was volatile. And then, of course, having a tax plan to start lowering their tax risk as they entered. And it really all came back to having a plan was the one thing that actually gave them the ability to take meaningful action. And as soon as the pandemic hit, we were doing Roth conversions. We were helping people with tax loss harvesting. We were helping people refinance their homes and just reevaluate their situation altogether because we had a playbook in place to make meaningful decisions. So let's take a minute and just talk about what a proper plan entails. What do you need to have a playbook to be able to do these things? Well, our mission at Pine Grove Financial is to organize your financial life in such a way that it's transparent, what one decision over another might be. As fiduciary advisors, we're able to be proactive in our approach because we don't have to arrive at some predetermined conclusion in order to sell a product. We're paid for advice, which means whatever strategy is appropriate to get you to your goals is what we're going to pursue. And we'll communicate that advice to you through a written financial plan that says step 1, step 2, step 3. If I was in your shoes, this is what I would do and how I would do it. And the way we stay accountable to that is that we can be an ongoing accountability partner to help you actually implement that plan over time. Now, what does it look like? Well, first, we need to find out, where are you on the journey? Are you still in the accumulation phase? Have you reached financial independence where you have the opportunity now to make different life choices? And if you're ready to transition to living on the wealth that you've saved, what organizational adjustments do we need to put in place to protect the wealth you've created so you can sustainably live on it over time and get the most from it? Well, there are 6 areas that you have the ability to control, but we want to take all of that and boil it down to something simple. We call it your retirement freedom score. And the basis of this is just on a scale of 1 to 100, what's the probability of your success? What's the probability that the things that are important to you are going to be able to play out over the course of your retirement with a little bit of money left over at the end? Now, what goes into that is something we call your retirement health stress test. And health is an acronym for your household income, your expenses, your investment allocation, longevity, taxes, and your health care. These are 6 areas that, regardless of wherever you are in life, you have the ability to control. Whether you're entering retirement with $250,000 or $25 million, you have the ability to manage how you claim Social Security sooner or later, how you claim your pension, lump sum or joint and survivor, how long you might work, understanding the bands of your wealth, how much money can you spend before you put yourself at risk, looking at your investment strategy, identifying what's the ideal investment strategy for you, looking ahead at legacy planning, making sure you have the proper estate documents in place, and managing the risks of retiring too soon or living a long and healthy life. Looking at what's the most tax efficient way to build your wealth now, and what's the most tax efficient way to distribute it in the future. And then looking at healthcare, looking at costs leading up to age 65, the transition to Medicare, and what it looks like towards the end of your life. Then we take all of these 6 areas that you can actually take action and make a meaningful impact on and boil it down to something simple. If you didn't do anything, just on the track you're on right now, where are you at? And for Bill and Sally sample here, there's a 53% chance that they're going to be successful. Welcome aboard Delta Airlines. There's a 53% chance of landing today. That's a little uncomfortable, right? But with a few modest adjustments, they're able to move their probability from 53% to 87%, with an average balance at end of life of $1.2 million instead of only $130,000. Just this ability to see this clearly is a much better scorecard to understand where you stand. Now, what would it take for Bill and Sally to move their probability of success from 53 to 87? Well, it was a lot less than you might think. For Bill and Sally, it was just working 1 more year. So you can see current to proposed, moving from 65 to 66, working 1 more year, spending $500 a month less, having a more moderate investment strategy, delaying Social Security to 70. These are just some of many, many different scenarios and life changes that they could make to move the odds in their favor. This is a much better method to help you see specifically what can you do to give yourself the highest probability of success. So it doesn't matter what you're seeing on the news and you see the market selling off. That's only one factor affecting your entire retirement health. And knowing the forest for the trees, if you will, to have proper perspective gives you the clarity that you need to be able to make good decisions. Now, when it comes to having this retirement health stress test evaluation done, who is this for? Well, this is for those that maybe have done a lot of planning but would find value from a more professional review. Or maybe those that are nearing retirement and they just don't feel ready. Or those that have done a lot of planning on their own, but now they realize that it's time for a second look. And my favorite, those that are actually out actively looking for a long-term planning partner to help them navigate their retirement. That's what I'm here for, and that's what I love to do. So if you're interested in visiting with me and having a discovery call to learn more about our planning process and maybe how I can help you, then click the link next to this video to schedule your discovery call. And you don't have to prepare for this. All you have to do is come ready with questions. And during that call, my goal will be to get you some clarity, help you see your options, and help you decide if you want me to go ahead and start building out a plan for you. And if you say yes and you decide that you want to do a plan, then our team will send you an email with a link and start the process to start building out your analysis. And then over the course of the coming 4 to 6 weeks, we'll meet a couple of times. Right now we're doing those meetings over Zoom calls, but we'll meet a few times to go through the process to let you see where you stand and what you can do about it. Hopefully this has been valuable, and if you take advantage of the discovery call, I look forward to visiting with you. My name is Jeff Clark. I'm a wealth advisor at Pine Grove Financial Group, and I wish you the best for your retirement.